This is our Forex blog for August 10th, 2011, and we're about to release a new version today that has the best tool we've ever released in the history of our company. So make sure you come to tomorrow's class so you can see how to use it, if it's not intuitively obvious once you have it. But basically every day we look at the currency meter and find the strongest ones to buy and the weakest ones to sell. The yen was strong on all time frames, daily, weekly, monthly trend was strong, and it was consistently strong today. You want to trade that against one of the weaker pairs. You know, the CAD, daily, weekly, monthly trends down. It was weak from 230 to 430. The new tool we're releasing is much faster in showing new trends, so it very likely would have switched to a downtrend maybe at 2. It's 5 to 25 minutes faster than this. But basically at 2, the yen was strong, the CAD was weak on all time frames. Guess what? You want to sell the weak CAD versus strong yen. It's a no-brainer. And you can see coming up to 2, it was above its hourly moving average. It had a narrow range pattern, broke down. You know, if you really believe in a trade, you know, you put your stop above the high and you kind of give it room, at least 2 waves down, you're out of your trade here. You might have gone short here with a small profit. And then many hours later when it broke down, coming up to 8, it fell about 80 or 90 pips. You know, and the currency meter showed that those were the pairs to trade. Notice how strong the yen was from 6 onward, and especially 7 to 9, the CAD was extremely weak. The New Zealand, the weekly monthly trends down. Same thing with the Australian. You can clearly see the Australian dollar is weaker than the New Zealand. 7 o'clock here, it goes weak again. The yen is actually very strong at 6. It's stronger than, you know, the mildly weak Australian yen. So from 6 o'clock onward, really, you want to sell the Australian dollar as well. Here's 6 o'clock right here, and this currency just had broken underneath the hourly, and it really took it about 2 hours and then finally broke down and fell 125 pips. The Intella stop, you know, had you short from this bar right here. When you run it live, it is vastly superior than you know, when you bring it up after the fact. When I leave these running for class, you'll see it does a much better job. Also note my Fibonacci retracement area was the high of the day, and so when you get a double top up here, you might have even, you know, jumped the gun on selling this quite a bit early. One of the new tools we have is called the I'm going to call it the Fisher Transform. When in the final release mode, let me just show you how that looks on here as well. It's also quite early in showing your reversal. So here is an area you want to sell. Here's your sell bar right here. This bar here is green, but the new tool is much faster. You know, you're out. Again, in right here on this bar for a little bit of a drop. And when it's selling off like that and you see any kind of green bar, because this is a very fast tool, just tighten your stop a pip or 2 above that bar's high, and the false signals, you know, won't get you out of your trade. You know, most of the time it reverses back down and it continues. The pound, extremely weak, pretty much from 2100 until 530. So the pound yen, also a no-brainer one to sell last night. 2100 is right here. It just broke underneath the hourly moving average. You have this nice little 50 or 60 pip drop. You have a beautiful rectangle pattern right here that when it breaks, it falls. And also, let me just quickly review for those who haven't seen it, our pound yen range bars. You might want to use, because this is a little bit more volatile, 10 pip per bar chart. And it really makes it clear where to get in and out, and, you know, it's much cleaner than a time-based chart or a tick chart. Let's scroll back and look at this, you know, last night. You have a big drop here. 2100 is right around here. Nice, beautiful move right here. You might have gotten out of that trade here, re-entered, made another 30 pips, waited for a little pullback, made some money. This pullback here made some money. Nice. Anytime you see a 3 to 5 bar sideways up and down thing like this, usually when it breaks down, you have a nice strong trend from there. You also have the Fibonacci profit target off this first wave as a very likely place to get out of the trade. Now, in the past, we've always said get out of half your trade at the first fib target. wait for the momentum to slow and get out of the second half. Now with the new tool, you don't have to. You can just kind of wait for the first sign of a green bar and put your stop a pip or two above it. In this case, you might have still got out of your trade right there, but this was a reversal of the trade. You wait for a decent pullback, you go short, you make money. Short here, again, you made money. And let's look at this on the CAD yen too later today when it was dropping. You want to look at each currency's volatility to decide how many pips per bar. The euro dollar, you might use 6. More volatile pairs, you might use more. But it's a very clear pattern. Let's say you sold this pullback right here. You might have made a little bit or broke even. You wouldn't have lost more than 5. Shorted again here, fell 15 pips. Again, if your stop was underneath here and you really expect to get it to fall, it pulls back right near break even, starts to fall again, you move your stop down. Most of the time it's only a matter of when these currencies make their moves. And again, with the fib target, in the past we always got out of half the trade here. This one fell another 20 pips. You have a green bar right here, put your stop a pip or two above that bar's high, and you're out of this trade at 26. Amazing 75 plus pip trade using the range bars. They're very clean, and it just keeps you into the trade. There's, as each bar unfolds, it might go up a little bit, down a little bit, up a little bit, down a little bit, but it doesn't jig you out as much as looking at, for instance, a 5-minute bar. As this thing fell, notice, you had this up bar right here. You might have been nervous. You might have got out of some of your trade there. This was a pretty violent move, but it wasn't, down, 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 down like the range bar. You had an up bar that closed up here. The Swiss, the longer term trend of the Swiss is up. It was pretty choppy today with, an hour of weakness, hour of extreme strength, weakness, strength, 2 hours of weakness. But at 8:30 here, it became really strong. And one of the weakest ones was the euro. You'll see in our regular class today that there was a clear sell signal at the euro at 8:30. This one gave a sell signal, just a mild one, at 8:35. The other one was, I think, 10 minutes before this, and it showed extreme weakness. So at 8:30, you really wanted to sell all the euro pairs against the yen, which was strong, the dollar, and also the Swiss was extremely strong as well. Let's look at the euro dollar on a 6 pip bar. Has to download tick data in order to use this. Alright, so at 8:30, or actually 8:25 is when the other tool that we're about to release today gave a sell signal. That would have been about right. 8:25. So at the end of the 5-minute bar, at the end of that would have been 8:30 because the bars are timed at the beginning of the bar. So it would have said to sell right here. And you have, just look at how beautiful this drop is. If you use trailing stops, anytime it has a little wedge pattern like this, you might move your stop down above here. It goes down lower. And at that point, you already have a huge profit. So it's not likely to go beyond the fib target of this next wave. So this is a decent place to get out of it. Again, the first green bar at or below it, put your stop a pip above here, and you're out of this trade here at 39. Short at 47. So you have 120 or so pips in this trade. Euro yen also just got shellacked today. The euro yen moves about the same as the euro dollar, so 6 pips per bar is a decent amount. Let's scroll back at 8:30, and notice the smoothness of a range bar. You have, you might have earlier on, if you wanted to sell every wave, once you have a big move down, you sell the pullback here. Again, it really didn't move that much, but you could have got out of your trade with a few pips or break even. Kind of double topped here, you go short, and then at that point onward, it just collapsed. But let's say you missed the first move here at 8:30. It falls down, you get a 3-bar pullback, which oftentimes is a very good pattern to find. 2, 3, basically 2 bars against the trend up to 5. The first bar, it goes red, you go short at the end of the bar with your stop just a pip to 3 pips above the high, and again, you're off to the races here. If you miss the 8:30 sell at 60, you're short somewhere around 40 with a very tight 7 or 8 pip stop. It goes down, you put your stop here, and again, you never know how far these things are going to go. Don't get greedy, draw your fibs on here. and you might have got out of half your trade here and the other half here, and I believe it continued a little bit more beyond it. But here's another example of you know, it had 2 bars up, 1 red bar. If you shorted here, you lost 6 or 8 pips. You have a 3 bar up right here. If you shorted here, you can see it kind of came down, went sideways, went lower, and you would have got out somewhere down here between 70 and 50. But nonetheless, you would have made 20 to 40 pips on that after only losing 8 pips on the first one. Right here, 2 bar pullback. That's not really that much of a pullback after being down this much. So the farther down it goes, the more likely you're going to want to find a 15 to 25 pip pullback before you go short. If you only wait for an 8 or 10 or 12 pip pullback, your odds of making money on that trade are greatly reduced. You can see this one here worked barely, but don't be greedy.